Asia-Pacific real estate investment grows by 13% in Q4, mostly due to one major deal. But overall market activity remains slow, with low yields and high interest rates still weighing on recovery. To discuss this, we have Mark Cooper from Urban Land Institute Asia-Pacific and Stuart Porter from PwC. So, despite the volume increase, why is market recovery still weak? Mark, would you like to go first?
It's uncertainty. Markets don't like uncertainty, and real estate markets are no different. We had what was, I think, really still quite a sluggish final quarter of last year, which is obviously amplified by the big AirTrack deal. But still, there is a lot of uncertainty about. I suspect that people got a little bit optimistic following interest rate cuts in the US in the last quarter, but then the chaos, for want of a better word, that's kind of followed the Trump administration since its inauguration has upset markets again. Hence, we have a lack of activity.
I think it has a lot to do with the nature of the market. It's a very fragmented market in Asia, both in terms of which territories are doing well and also which sectors are doing well and which sectors are not doing so well. And in particular, when you look at commercial real estate, which traditionally is more than 50% in some areas or countries, 60% of the market, leveraged investments into commercial real estate are very difficult to justify at the moment. And even in a place like Japan, where interest rates are very low, interest rates went up by 25 basis points in January. But that's double what they were for almost 17 years, the basis rate. And so there's an element of uncertainty about whether that's a long-term play at current pricing. Hence, there's a lot of discussions about the large nature of the bid and offer spread in the market. And that's certainly having a knockover effect to the overall business, even though there are very successful niche areas which are starting to become more mainstream, and certain territories like Japan, Australia, and India, Singapore, who are doing very well relative to the others.
So what must change for Asia-Pacific's capital markets to recover?
Well, I mean, there's that uncertainty about interest rates, I think as Mark mentioned. And even in, say, the location I am in Japan, interest rates went up in January, only 25 basis points. But that's the first interest rate rise we've had in 17 years. So naturally, when you start to project that, what might happen in the future, that does create more uncertainty about what was a very stable market. So there's an element of that. Work from home is not so important in Asia, particularly in places like Japan and certainly in Korea, as our reports are showing. But they have had an effect, but it's kind of leveled out. So I think it's really just once we get more mature businesses or mature markets in those niche areas, I think we'll see a greater recovery than we have at the moment.
I think certainly any movement in downwards in interest rates would be a boost for the market. And likewise, if there were further price corrections, then that would also help, increase the all-important gap between the cost of borrowing and real estate yields, which makes real estate investment a much easier proposition. I also think, going back to what Stuart said earlier, that it's a really diverse market in APAC, and so there will be different things happening in different markets. For example, China and Hong Kong are suffering quite a bit of oversupply at the moment. And that is going to be a problem for the market to digest, regardless of what happens with interest rates elsewhere. And there will be other markets, say India, maybe even Japan, which is still doing pretty well, where you could expect to see better performance as well.
Mark, could you also confirm if investor focus on logistics and data centers is considered a long-term shift?
Yeah, absolutely. I would say that logistics is now a very important part of institutional real estate investors' real estate portfolios. It's probably been a rebalancing that's taken kind of 10 plus years as logistics and, to a lesser extent, residential has replaced some of the retail and some of the office properties that were in institutional portfolios. Those retail office properties are still there as well, of course. Data centers is slightly different. There is some disagreement about whether it's real estate or infrastructure, but regardless of which bucket it's held in, this sector is seen as a fundamental infrastructure support for modern digital business, and therefore I think the interest is going to be long term.
Yeah, I mean, you can look at some of the statistics. They're very broad, but let's say there's 200 or so data centers in Japan, and there's 5,000 in the US. So there's much long-term opportunity, and you see that in the rest of Asia as well. On the other hand, if you talk to the engineers and the real specialists, you've got grid capacity issues in places like Japan as well. So the growth may not be exponential to the extent of catching up to places like the US, but it's certainly there and embedded. And yes, DeepSeek and others have a little bit of a shock to the thinking, but I don't think that changed the trajectory, but it probably just makes a little bit more the analysis, a little bit more refiner and thoughtful, as opposed to just piling in. So there's an element of that that's coming through, I think, in the smart operators as they're looking to make investments.
And just for a better understanding on our current status, how are institutional investors adjusting their strategies in response to weak capital market activity?
Well, we've had the pivot in Asia, within Asia, from effectively China to Japan and other places. And then we've also had certain large developments intra-Asia, such as the Japanese developers have certainly made big inroads into Australian residential. And Australian residential is a capacity where you've got large capacity, so you really can make an impact rather than, say, a niche area. So you are seeing those types of flows where seeing opportunities. And you've got much more players coming into the Japanese market who develop businesses, particularly in the US, who are looking at renewables and other areas, more say solar than wind farms because of costs, etc. But again, they're looking at different ways. And you've got private equity investments in Japan and in Asia have been increasing a great deal. And a lot of them have carve-outs of real estate into real estate funds or real estate players who are affiliated with those private equity operators. So we are seeing kind of good areas where more development when you look at it in detail.
Yes, I mean, I'd add that actually, if you look back at that last quarter of last year, it's probably a pretty good example of how things are going. So we've had a fairly quiet time, and less activity is how institutional investors adjust in a way to difficult times. But we also saw the air trunk deal, which I think is important because it shows a group of major investors taking a long-term thematic approach to investment. And I think you'll still see more of those kind of transactions where an investor's belief in the structural themes will mean they can kind of look past the noise of current events and look for long-term deals, and probably quite chunky ones.
Thank you so much for joining us today, Mark and Stuart.
Thank you.
Thank you for the opportunity.
Once again, those were Mark Cooper, Senior Director for Thought Leadership at Urban Land Institute Asia Pacific, and Stuart Porter, Asia Pacific Real Estate Leader at PwC. For more news, visit realestateasia.com.